Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm going to talk about a recession, real estate, all those different things. And I'm going back and forth on Twitter with a whole bunch of different people, and I'm just going to state my case. I'm not making predictions. What I'm trying to figure out is, are the trends still intact? Are the trends in place? And have those trends changed? Those are the questions you should be asking and trying to find answers for. And what people are doing is they see any sign of weakness and they say that the trend has changed. That is not the case. So when the housing market gets a little bit more inventory, it's still going to go up. Even though the inventory is going to come back and it will go up at some point, home prices are still going to go higher because the inventory is still at low levels. I'm looking at inventory greater than 6 months. We're at less than 2 months. Now, we also have to look at the drivers. What are the drivers? The drivers to me is the real estate market, the housing starts are the drivers of that inflation and stuff coming into the system. Just because something is slowing doesn't mean that the trend has changed. If someone's driving a car and they're going 140 miles an hour, they're going, wow, that guy's going fast. But if they apply the brake, everyone sees that they're applying the brake and they're saying, whoa, this guy's stopping. We're going to crash. And you're like, you're going to crash. Wait. And I don't mean crash the car. What I mean is to reverse in the opposite direction. You're going 140 miles an hour. You start applying the brakes. That doesn't mean you instantaneously go backwards. It means that you're applying a force to slow you down. You're slowing down. First, you have to slow down. In order to go 140 miles an hour in the north direction, in order to go south to turn around, you can't do that on a dime. You can't just turn around and go backwards. You're going 140 miles an hour, and whatever the weight you have is the momentum going this way. You can't just turn around. The markets are the same thing. The markets are going 140 miles an hour in the upward direction of prices in the real estate market. It can't just stop and go backwards. The trends are in place. The inventory's gone. So when we look at these things, the trends don't change that fast. You don't need to make predictions. Predictions are not necessary. The things move too slow and people want data. Data is backward facing, not forward facing. So, and then obviously this is all from my opinion, but the market, the housing market, the real estate market's going to take years to turn around for a negative, like for a decline in real estate. Okay, maybe something miraculously happens and it happens in a year. I highly doubt it though. So when I read a lot of these comments, and I'll read some of the comments with you guys and kind of go through it about what I think is coming. It says, not in the US, don't see it crashing. This is from Scott. Now, New Zealand and some of these other places are in a much different area than America. Remember, it's demographics driven, and it depends on the pricing of the homes. We're not that expensive in the United States in relationship to how much people make. You have no idea what the Australian markets and New Zealand markets are pricing in. They're 15 times earnings. We're at like 5. We could go 3x upwards to catch up where they're at. And they're at crazy levels. I agree with that. That means interest rates could break their housing market because they're at what I would consider to be a critical level, and the demographics is starting to run out in some of those areas if you take a look at their demographics. So interest rates matter only when you're at the fringe levels, not when you're at a huge shortage of homes. I don't think it's going to have as large of an impact. I said, we are in the biggest squeeze of housing, which is right between the recovery phase and expansion phase of real estate, which that means is you've got the largest amount of buyers in relationship to the supply that's out there. Then your housing starts kick on. That is the cycle. It's not my thesis. It is the cycle. And that is a fact of the real estate cycle. Your largest amount of buyers to seller ratio happens when you cross over from a recovery phase to an expansion phase. That is exactly the spot that we are at. We are transferring over into a early expansionary phase of real estate. And it says, I'm not seeing it at all. I own a small construction company in New England. I work on new homes only. People who are affected by rates were priced out of this market a long time ago. And what happens is when you have 10 or 20 buyers for every house that's available, all of the people that are dependent on interest rates are out of the market to begin with. It doesn't matter what the rates are at this moment. Maybe. I'm not saying 100% fact. It may impact some people in the market, especially maybe first-time home buyers, where they need more loaning power to buy the house. But those people are getting priced out pretty quick because it's people who have cash and money that are putting larger down payments or no down payment. They buy the whole house outright cash. And it says we've got here in September 2020, JP Morgan entered a deferred prosecution agreement and agreed to pay $920 million, including $436 million criminal fine. And what I was talking about earlier was these guys are pushing the markets all around. They're using it pre-market or aftermarket to hit the market with everything they got to get all this fear in the market, to get sellers to panic sell out. I think that they're going to do the same thing. They could do it in oil. They could do it in all sorts of markets where they're going to try to position themselves long on these things if they're not already long. They're going to push this market around, and you're just going to have to ride through it. Mark is saying, if there's such a supply housing deficit and huge demand for homes, then prices, like you guys said, should keep climbing. I'm saying high rates kills demand, as you are seeing. And I don't know if that demand has already been killed or not. I'm looking for the signs in the inventory levels. I'm looking for the house prices to start slowing. And I just haven't seen it yet. Doesn't mean it won't happen. But the markets are slow to move. I want to see the data before I make a decision on changing my stance. And it's probably going to take 6 months to a year for me to change my stance, because the markets move slow. Remember, that's back to the time frame that investors should be looking at. It should be long time frames. Interestingly, the same chart showing, oh yeah. It says they were talking about oil prices. Oil prices. So why would he say this? You know who has the most oil on the planet? So Mark thinks that, sure, in like 50 to 75 years, it's not a function of how much you have in reserves. It's a function of flow. It's the flow that matters, the flow rates, not reserves. And even so, the flow rate given a certain reserve slows down as your reserves deplete. So your flow rate, you could have 1 billion years. You could have 1 billion years of reserves, 1 billion. And guess what? It still might not be enough. Why? Because you can't flow the 1 billion years of reserves at any sort of substantial rate. Maybe it's spread across the entire world in trace amounts that you'll never be able to get out of the ground. So the reserves don't necessarily matter. It's the flow rates in oil that matters. And here's the article. I've read this one. I'm a dinosaur, but I've never seen these things, Saudi Minister Prince. The world needs to wake up to an existing reality. The world is running out of energy capacity at all levels. Why do you think I'm positioned so heavily in natural gas, oil, and uranium? Because the root of the problem is rooted in stupidity of putting in renewables without a viable plan. There's no viable plan here. They don't have any storage capacity. I don't know if it'll work, that storage capacity. I don't know if renewables will work in the scales that they're trying to implement it at. Maybe we can only work in renewables at a 20% capacity area, or 30% or 40%. Maybe the 70 to 80% capacity, which I know we're not at yet, maybe that's a theoretical topping point, which doesn't work in application. I don't know. We don't have the storage capacity of electricity at this moment. And a lot of people think that that is the problem. I'm not 100% sure that that's the problem or not. These things also have the way that they cycle on and off, and the way that clouds impact solar, and the way that wind impacts wind, may or may not work at a substantially high amount of renewables. And I don't have the answers. I'm not an expert. I could probably ask my brother, who is an expert in this stuff, but I'm not. And a lot of people, they get scared, and They think that this market, the housing market, is just going to turn on a dime. Now, if it does turn on a dime, we can see in the inventory. We'll have plenty of months to work ahead. But the importance here is the real estate market. If we lose the real estate market, you could have a deflationary crash. I think what's coming is not a deflationary crash. I think the housing market's going to hold up just fine. I think demand for oil is going to go crazy. And I think that we're going to have a problem in the energy area. We're going to get a huge spike and we're going to get a big recession in not from housing, but from other things. And then it'll come back, and then we'll get like another crash maybe. We're so screwed up in the energy sector, and that's why I have so much money allocated to it. Is I think we have to go that direction. And if you've been on the Finding Value website, the Platinum membership, you can see the companies that I'm positioning in. I'm not playing the game of the short term. I'm playing this for the next 10 years, guys. There's huge money out here. Whenever you have, I'll put it this way, the largest problems that humankind faces has the largest rewards for them to be solved. I'll say that again. The largest problems that humankind faces coming up in this next area, the next time frame, the largest rewards will be there. And if energy is our biggest problem, energy is the base, it's the everything of life. It is life. And what would people be willing to pay for life? Everything they've got. So energy, I think, has huge opportunity for investment. Huge, huge, huge. And that's why if you look on the Platinum membership on the website, why I'm positioning in some of these companies. This isn't about short-term gains. This is playing chess at the big boys table of where the big money's getting distributed at. And I'm trying to figure out a plan to basically think about the future. If renewables aren't a viable option, and some people think that they're not, and I don't know necessarily if we can implement them at the rates and in the quantities that people want to put them into application. I think that we're going to have mineral constraints and energy constraints, and I don't know if they're going to be economically viable. Everyone has looked at renewables and said they've gone down 90%, but at the same time, commodities did at the same time go down 90% too, and that's all their input costs. So if their input costs and their minerals costs all go down 90%, of course that's what's going to show. It's not from a scale of manufacturing. It's not from economies of scale and ramping these things up. It was because the input costs went all the way down. Now, if your input costs go way up, they're going to become uneconomic. It's kind of weird. They're basically hinged to the price of fossil fuels, and they're hinged to the material costs that you're getting it out of the ground. And if that all goes belly up, if we hit huge shortages, I don't think renewables are going to be a viable option. So then you have to look at the markets differently. If we're going to have aluminum shortages and steel shortages and zinc shortages, silver, and all these other, maybe not silver, they might or may not, it depends. But I know zinc, aluminum, copper, like all these ones, if we can't run the lines out to renewable, what's the value of renewable? If you have hit these huge deficits of some of these minerals. Now someone's going to look at it and say, okay, well, what's the most amount of power that we can get with the least amount of minerals? Uranium, nuclear. And then you've got these small modular reactors. Small modular reactors are what? You can put them in a facility, you can pump these things out, and if they're modular, you can add and stack them up. It's pretty smart. It's pretty smart. I think that's a good smart solution. I think we're going to go with that solution. Why? Because you don't have to do custom designs. You can just build it, have a nice solid design, set up a manufacturing facility, build these things with a high output. Since they're standardized, they're probably going to be very safe. They're going to have a large safety factor. They're going to be overbuilt, and we can build them quickly, and you just build more if you want to stack them up together. That's perfect. That's exactly what I would do if I was creating a company. I'm a manufacturing guy. That's where my background in training is at. It's manufacturing. It's like set this thing up, pump them through, and then stack them, and have them all be the same. If something goes wrong, you can pull one out and put it and replace it with a new one. I mean, that is genius. That's perfect. I'm putting money behind it. You want to know what the company is? Sign up to the Finding Value website, the Platinum membership. Now, there's also other things with uranium enrichment. There's a whole bunch of other plays that I think are worthwhile taking a look into. And uranium itself. If we're gonna ramp this, and we're gonna remember when we hit, if we hit a world that I think we're hitting, they're gonna run these nuclear power plants longer. They're gonna extend the lives of them. They're gonna start firing these things up like Japan is. And where's that uranium gonna come from? It's gonna be a huge squeeze over there in uranium. Why? Because it's the superior fuel, the superior electricity generation source, measured by energy, measured by minerals, measured by anything that you want. It's the cheapest on an energy kilowatt hour basis. Why wouldn't we go that way? And if you're in an energy crisis and everybody wants it, what's the value of it? Probably a lot. So I think, at least in my opinion, that's probably one of the smartest areas to have some exposure to. And then everything that's existing that's going to be in shortage, yeah, those are all good spots, like oil, natural gas, maybe even coal. Coal might be a great bet through this energy crisis and the transition. I just think I'm loading up in natural gas because that's where I think the largest opportunities are. And if you guys want to know what they are, Platinum membership, go ahead and you can sign up and you can see what's in my portfolio. I've got a lot of smaller to mid-cap oil, natural gas companies. And that's how I'm playing it. So I've been going through these messages here. Nobody ever said that. I said we will see disinflation, as so far you're seeing, and not possible deflation. Housing market gets hit the least because there is a lag time for housing, then the Ponzi scheme gets bailed out. Maybe that's the case, maybe. But I would not jump to conclusions. It's slow to move these things around. There's a decent case to be made that the market already priced in peak tightening expectations and will now start focusing more on economic deterioration as it begins showing up in the data. But I also, if you bring up the Fred housing starts, and this is one thing that I watch a lot, is we don't have any these gray lines. These recessions all happen with the declining housing starts. Almost every single time the housing starts decline, you get these recessions. The only time we really didn't get one was in the 2000s. And I think that's what is going to happen, is we're going to go into a housing squeeze, and the squeeze on the markets is going to be a supply-driven squeeze from commodities and the housing market from the demographic coming through. And I don't know if we're going to get some big blowout recession. I think we could potentially get a recession, yes, and we could potentially be in one. It's squeezing some of this garbage out of the system. And then I think the money's all going to rotate over to commodities and things that people need in order to survive. So that's my guess here. Now, I haven't seen these imbalances this large when looking at history. Now, obviously, we're kind of living through this. So these imbalances, the larger the imbalance, the more opportunity there is. And I think the opportunities come in the next couple of years. We're right at the beginning of a big move. And if you guys want to position correctly, if you need help positioning, sign up to the website, the Finding Value website, the Platinum membership's the membership that I would sign up for myself, because you get access to absolutely everything. We have question and answer sessions. I put the videos up for our previous ones. You haven't missed anything. And I'll probably do some trainings here shortly with technical analysis training. So that's what I've got for today, guys. Give me a thumbs up for the content. Subscribe to the channel if you haven't. And thank you for listening. This is Finding Value.